You're watching The Open on BNN Bloomberg. We are tracking the markets 30 minutes into the trading day, and we're out of bed at least. That's the most that we can say. Sort of mixed trading here, flat ahead of some key catalysts later this week. We've also been tracking these home improvement stocks, retailers like Home Depots and Lowe's hitting fresh all-time highs as a hurricane barrels towards Florida. Hurricane Milton, so devastating, Cat 5 hurricane. But investors focusing on the subsequent rebuild effort before it even takes place. We've also got our eyes on the U.S. election, now 4 weeks away. What does it mean for Canada? We'll ask the folks at Desjardins that's put pen to paper on this topic. But first, here's a look at some of the top stories we're tracking for you right here in the BNN Bloomberg newsroom. Shares of Alimentation Couche-Tard are basically flat right now after the Quebec-based convenience store giant raised its takeover bid for the parent company of 7-Eleven. There are reports that the offer has been increased by about 20%, bringing the total value to $47 billion U.S. 7&I says it will continue to maintain the confidentiality of discussions with Couche-Tard. The U.S. Justice Department says it's considering asking a federal judge to force Alphabet to sell off parts of its business. Antitrust enforcers are weighing a breakup to mitigate Google's dominance in search. The DOJ could also try to force Google to provide access to the underlying data it uses to build its search results and artificial intelligence products. Boeing's talks with striking workers have stalled for now. The company has withdrawn a contract offer for machinists who have been on strike since mid-September, adding that further talks, quote, don't make sense at this point. Boeing says the union did not consider higher proposed pay during talks this week, while the union says the company refused to improve wages, vacation, and sick leave. Well, shares of Couche-Tard under a little bit of pressure here, but they've been on a bit of a downward trajectory for the last couple of months as they have been in hot pursuit of the 7-Eleven franchise. And reports suggest that they've sweetened their bid 20% better than it was before. Let's bring in a shareholder. We've got Allan Small, Senior Investment Advisor at IA Private Wealth. What do you make of this sweetened offer? Do you like it as a Couche-Tard shareholder?
I think so. I like it. I think for the long term, that's how Couche-Tard grows, as we know. Obviously trying to be the biggest in the world, really. And I think this makes sense. Hopefully they can get a deal done. You know, you're looking at a name trading at around 18 times forward earnings. It's okay. It's not too expensive. It's not so cheap. It's kind of just about right. And overall, you know, I think Couche-Tard got up to about $88 a share. So trading down, I think a lot of that had to do with its last quarterly earnings, not the greatest. So I think if you're an investor, you continue to hold it and wait and see what happens.
Let's talk, you know, Couche-Tard gets a lot of credit, and they've earned that credit as really sharp when it comes to capital allocation and doing deals. Having said that, this would be the biggest deal. It would be orders of magnitude larger than what they currently are in size, and it's with a new CEO at the helm.
Yeah, interesting. So it will be, obviously, a make or a break, at least initially, for the CEO. We'll see what happens. I think overall, as I said, I think Couche-Tard, this is what they do. They make acquisitions, as you mentioned, very wise, very smart in their acquisitions. This is the biggest. So that tells me that they really want this to go through.
So why is the stock selling off?
Well, anytime a stock makes a purchase for another company, it's usually the acquirer that sees their shares go down. How are they going to pay for that?
By this much, though? If the market likes it, that's not always the case. Is it fear of dilution?
No, well, perhaps. But also, I think it also had to do with this stock started going down a little while ago, right? And I think that had to do with their earnings. I think they kind of hit a bit of a wall. They were a bit stagnant. I think to get to the next level, they had to do something, and I think this is what they figure is going to get them to that next level.
Speaking of hitting a wall, the TSX has been underperforming over the last couple of sessions, down now 3 days in a row, though it's starting to turn things around here. A couple of problem spots have emerged. Energy has been weak, then it was strong for a week, and now it's sort of waffling here. How are you thinking about energy exposure in general? Do you like crude? Do you like the Canadian energy players?
I think as part of a diverse portfolio, you need a little bit of energy. However, when you look at energy or look at oil in terms of pricing, what's it going to take to see oil back at $90 to $100 a barrel? You know, we're seeing obviously all the tensions in the Middle East. That hasn't done it. We're seeing obviously the situation in Ukraine. That hasn't done it. We've seen China stimulating by cutting interest rates and doing everything they can do to stimulate their economy. That hasn't done it either. Not to mention a hurricane in the Gulf.
Why do we need $90 oil in the first place? I mean, can't these producers have a nice life right here?
It's, I think they can, but for us to see oil move higher and energy producers move higher, I think you're going to need to see price of oil get higher than it's $70 a barrel, which is where it's been hovering around 70, 75. I think if the tensions in the Middle East kind of subside, once the hurricane runs its course, and if OPEC actually considers or actually goes through with their increase come the end of the year, you could see maybe as low as $50 a barrel oil. I know that's what the Saudis are thinking, and that is quite possible. So to me, oil, to get it up to, I guess, 80, 90, $100 a barrel, I can't see a catalyst to get us there. I think we would have seen that catalyst already. And because oil is still pretty low, to me, I just think there's a lot of oil production. U.S., remember, producing over 13 million barrels a day. They are the largest producer by far, and they have the capacity to perhaps increase that to 14 million barrels per day. So if the Saudis start producing more, the OPEC plus nations start producing more, I think you could see oil fall instead of move higher.
Saudis did not like that report. Remember, around $50 in oil. They came out and refuted it. Let's talk materials. A little bit of a fire under the sector, maybe because of China's stimulus, and then that seems to be coming off the couple of days. And then you've got gold. Anything interesting in that space to you these days?
Well, I'm not much of a gold bug myself. It's hard for me to understand, gold going up just because the U.S. dollar weakens. And so I'm a bull on the U.S. dollar long term, so that's why I have a problem with gold. But obviously, you can make the case for gold. Many have over the last, for quite a while now. As interest rates come down in the U.S., are expected to continue to come down, you want to own some gold, I should say. And so for me, yeah, you can make the case to continue to own gold, trading near or at all-time highs. And going forward, as long as the Fed continues to be on that rate cutting course, which I guess we'll have to see CPIs coming out in the U.S. pretty soon. We're going to see, obviously, the last two meetings of the year, what they say. Dot plots say another quarter point each meeting. So we'll see what happens. But gold could continue to move higher.
So on interest rates, we're going to get the U.S. banks reporting results on Friday. I want to just quickly talk about the Canadian bank sector because it's consolidating here, trading at around the highest level since 2022. For certain banks, the most recent quarter was something of a redemption quarter. For others, it wasn't. But how are you thinking about the Canadian banks in the interest rate environment and the slowing economy environment?
I like them. And the Canadian banks are interesting because it always seems to be the one that performs the poorest, the worst. Next year is the winner. And by that, even if you take that on a shorter term basis, you look at TD, Scotiabank, even a BMO, you look at those names and they've been the ones that have been struggling versus CIBC, Royal, and National. So if you were to get into, or if you would have gotten into those three names like a BMO, Scotia, or TD, you would have done pretty well over the last little while. I think the last time I was here, I said I like those names because right now they were struggling at that time. And I knew that going forward, they would just do fine. So lower interest rates is going to spur on, in my opinion, more activity, more borrowing, hopefully more mortgages, for example. So I think their businesses will continue to get better as interest rates start to come down a little bit.
You mentioned BMO, and that's the laggard of the pack right now. Would you add here?
Absolutely.
You're not worried about credit quality issues being worse than what we're seeing in the other banks?
I think that as interest rates come down, a lot of the credit quality issues start to get a little bit better. And I think we're going to see interest rates aggressively move down in Canada over the next 4 quarters.
Then another point, what would you do with Royal, which is trading at a historically elevated valuation?
So Royal for me is a hold, but not a buy, because it is too expensive at these levels. Yields are not anything that I would get excited about. I'd rather go into a TD yielding just under 5%, a Scotia around 6%, and a BMO over 5%. To me, you can get some good dividends and growth as these names continue to do better as interest rates come down.